Cailey Barker used to work for BlackRock at one period of time. He was a senior analyst there. He's now involved in several different undertakings in the mining sector, and he joins us now. Cailey, how are you?
Well, thanks, Alistair. Thanks for having me. I'm delighted to be here.
Yeah, it's great to see you, and great to see that you've been picking up some various different types of roles in the mining sector now that you've moved on from BlackRock. I'd like to ask you about a few of those, but I think the best place to start possibly will be with Xcelsior. That's a company that a lot of people might not be familiar with. So tell us a little bit about that role and what you're doing and what it is.
Yeah, indeed. Not many people have heard of that, and not many people have heard of the company that it's backed by, which is Wogen Resources. Wogen, a very well-established metals trader, been around for 40 or 50 years, and trading in specialty metals. So they're sort of quite small relative to the big metals traders, but very big in those specialty metals. So antimony, graphite, chrome, tungsten, rare earths, all those sort of weird and wonderful metals. Those are the things that those guys trade. And they've been around for ages, and very well established and very dominant in those markets. The kind of thing they've not really done much of is the investment side. So Xcelsior Capital is a relatively newly formed vehicle that is basically doing, if you may think of it as like the investment arm of Wogen, doing private credit and with a view to picking up the underlying trading angle for Wogen, and that's where we sort of started. We've done one deal to date on the Hillgrove mine in Australia, which is on the antimony stream, and we hope to do more. Yeah, so it's incredibly exciting, get lots of interest, very strategic, very niche.
So let's start at the very top then. So Wogan, tell us a little bit about them. Are they a listed vehicle or is it private? How are they set up?
It's private. It was listed for a few short years, about a decade or so ago, I think now. But they're private now. It's a sort of privately owned partnership owned by many traders and ex-traders. It's been around. It's in Westminster Abbey. I think it's been around 40 odd years in those offices, and has the King's Award for trade with China, because they've got offices, small offices around the world where they trade, and particularly strong links into China. And they're just the experts in these weird and wonderful metals that we all struggle to learn about. Basically, we can look on the screen at Bloomberg and try and find a price for antimony or something, and that might come from some of the usual consultancy experts like Argos or Platts or something like that. But those guys are speaking to the traders and getting the actual prices that they're making money on.
So Wogan buys from miners directly, does it, and then sells it on to customers? Is that how it works?
Yeah, pretty much. Buy at mine gate, does all the logistics, and then sells it to the end user. Well, I say the end user. It's usually they can they're dealing with upstream, midstream, and downstream customers all along the chain. So it depends on the product. Most products, as you know, don't really go to end metal. They tend to sort of end up as some concentrate or intermediate product, and they'll be buying those and selling those all around the world.
Is it a big business in dollar terms? I mean, you sort of mentioned that it's smaller scale than some of these other metals traders that we know about, but do they still sort of turn over a large amount of cash in this
Well,
line?
no, no, I mean nothing compared to the likes of sort of your Glencores, the Trafiguras, and everything. But they make a decent enough meal to do their business. And we're hoping with the relationship with Xcelsior Capital that will add quite a bit of growth, because they've been relatively, I wouldn't say static, but they've been certainly sticking to their knitting, and hopefully we can bring more trade and opportunities for both them and for us at Xcelsior Capital.
Yeah, I mean, you mentioned antimony there and also tungsten, I think you mentioned. I mean, these are sort of not renowned as big growth areas. I mean, sometimes they come into focus, don't they? I mean, antimony has been in focus a little bit this year, but sort of generally speaking, the broader investment community don't look towards tungsten and antimony and the specialty metals for massive upside if the global economy starts roaring away.
Yeah, well, that's right. I mean, these are incredibly small commodity markets typically. Tungsten's 100,000 tons. It's nothing in the global scheme of things. So they can be quite volatile. But what's happened, as you know, recently is all the resource nationalization, US led, Trump tariffs and so forth, and that's meant China shutting its borders, increased interest in security of supply, strains on supply chains, and you get different tiering of pricing. Antimony's got basically a China price and an offshore China price. And more importantly, I think what a lot of people fail to understand is, particularly governments, is you can't just invest in a mine and expect to get the metal out of it for whether it's for security reasons or national interest or quite often defense. You need to process it somewhere, and China has, of course, sewn up processing for decades in their country. So we're trying to help sort of provide a whole ore solution and be part of that chain and allow governments and people that want to invest in those areas to secure supply and get returns in this sort of metal industries.
So Excelsior itself will be a specialty metals operator as well, will it? Is that the remit?
But it's kind of an advisory, I guess. So think private credit, prepayments, royalties, senior secured credit facilities, et cetera, and anything mainly on the private credit side to start. We can do equity, and with a view to getting that underlying material metal for Wogen. So that's the sort of initial model. We can expand it from there, but generally speaking, it's sort of niche, I suppose, where the real IP and competitive edge lies is understanding those niche commodity markets that a lot of people don't have visibility on, but we do.
So you say you don't do equity. So is that a deliberate and well thought out strategy that you guys have, or is it just because you're starting and you may move on to it? Why is it credit only?
Well, both. I would say both, because these markets are quite niche. It's a sort of safer, less risky place to start, where you have you can get a liquidated return in a relatively short period of time. Whereas if you invest in equity as you know, in the small cap world, it's difficult to get liquidity, difficult to find your exit strategy. So it's just and because we're linked up with Wogen, it's just a sort of safer place to start. But that's not to say we won't do equity and we won't consider equity. Certainly more and more so in the future.
Right. So you could end up being a private equity vehicle, but you're not at the moment.
No, that's not the focus and at the moment. But yes, no, the world is our oyster, so to speak.
So if I had an antimony project somewhere in Morocco, say, and I wanted some debt, you would be the type of person that it would be worth getting in touch with.
Absolutely, yes. And what we would need is some site of metal, so it wouldn't be any use being an early exploration stage company. It's got to be, probably feasibility stage, so a few years away from production at the earliest, or preferably in production, even better. So Hillgrove mine in Australia, which is owned by Loboto, that for example is a historic gold antimony mine that will be putting back into production next year. So that would be a sort of sweet spot for us that we'd look at. But it doesn't have to be mines, right? We can look at all up and down the chain. Could be midstream, upstream, downstream. So recycling manufacturers, anything that we have an advantage in.
So you're quite happy to lend before the construction phase then? You mentioned a company might be at the feasibility stage and you'd consider that.
Yes, absolutely. And that's what we've done with Hillgrove. It's high risk, high return money. So, but typically these companies that want our want our money or want our credit and they want expertise in the market. So they're looking for some kind of sales or distribution and marketing agreement with Wogen. And also they're perhaps struggling to get standard project finance from a bank because they don't have the the bandwidth or the time, or it's too small for them, or all the other host of reasons that they would come to their typical private credit lender.
But it's not normally popular with investors, though, is it, to go into debt before you've got construction underway? Do you sort of find that from your side any sort of navigational difficulties, or is it on the company's side that they those issues will arise?
No, I mean typically we're going in at the sort of project finance stage, so they would
Right.
most companies would take on if it's your standard copper or gold project, they'd be taking on whatever it is 40% debt from senior secured facility from some syndicated blue chip bank lenders, with just sort of coming in at more or less the same stage, but it's higher risk, higher capital money.
So before we go on, could we perhaps name a few more specialty metals then? So we've had tungsten and antimony. I mean, are we talking about vanadium, for example? Does that count?
Yeah. I mean, I won't reel off the 40 or 50 odd commodities and products that Wogen trade. You can go on the website and check them all out. But yes, vanadium, rare earths, like some of the minor PGMs, for example, chrome ore, and concentrates and metals and ores and alloys. So it's a real interesting mix.
So these are the types of metals, I suppose, that will be sort of ingredients in steel for added to iron ore to make steel in sort of small quantities, but very important quantities. Metals like that, for example, would be some of the metals that you guys are interested in.
Yeah, that's right. I mean, traditionally, these metals have very specific properties, whether it's like they're more heat resilient or they're they add corrosion resistance or strength or something. So they usually that's absolutely correct. They're usually added to in the manufacturing process to improve what we live and breathe, the product materials we live and breathe on a daily basis. But we just don't see them, and we just haven't heard of them. I mean, there's I'm learning very quickly about all the different rare earth stuff and all the different metals and different products that the likes of Wogen trade. It's fascinating.
I mean, some of them are hard to say, aren't they? Like yttrium and ytterbium, or some of these rare earth elements are just better left abbreviated, on the periodic table than actually spoken aloud.
Well, that's right. I mean, most of the top, in typical cycles of days gone by, we would ignore most of these metals. But a good couple of examples, I suppose, like rhodium, which is, we all know platinum and palladium, but rhodium, which is probably the third biggest PGM, in the last 5 or 6 years when particularly when Russia and Ukraine went to war, the rhodium price spiked, and what was a very small part of revenue streams for the large PGM producers, the likes of Northern Platinum, for example, became about 40% of its revenues. And we're seeing the same thing in antimony. Antimony, when that, like for example, the Hillgrove mine and other assets, this is a penalty that you have in your concentrate, typically because it's quite nasty, it's quite deleterious to deal with. So you used to pay a penalty in it, and it's gone from what was a price of about $7,000 a ton to 60,000. So it's now, although it's still quite small in size, it's not very small in value anymore.
Yeah, it's amazing. Some of these metals, because their markets are quite small, they can move significantly, can't they, Cailey? If something else, in fact, some other factor intervenes on the supply side.
Yeah, that's right. And that's where we have to rely heavily on the traders to understand what they're seeing in the markets. They obviously have a privileged position of seeing typically 3 to 6 months before the rest of the world and the markets know what's going on. And I mean, they're speaking to all the players that know if they're desperate for material or not. and you need to be quite nimble in this, isn't it? And from an equity perspective, that's quite difficult to do because you don't have that visibility, and you don't necessarily have the liquidity to trade in and out of shares for what very few opportunities there are on the public markets in any case.
Are there any other players other than Wogen in this space of any sort of significant size or scale?
Yeah. There are competitors and some will trade, in some of those commodities more than the likes of Wogen will. Everybody sort of, you get very small traders that might just be a sort of one man and his dog, up the north of England, who's just an absolute expert in one particular metal. That's sort of very, very common, but there's very few companies of a sort of size that have a broader understanding of most metals and are able to dominate the markets, particularly with all the logistics and shipping requirements that you need for it.
Yeah, I mean, these metals do have their own sort of specific issues that come along with them in terms of production and then logistics, as you say.
Yeah, I'm just learning about a lot of this. It's a lot of it's quite new to me. Even the likes of lithium, which they trade. Storage is very key for lithium, not only because obviously it's a flammable material, but also it degrades. So you've got to know how to, how well to store it and how long to store it before it gets less useful.
So which specialty metals look good to you at the moment then, Cailey, from the point of view of tight market or undersupply or however you go about analyzing these things?
Yeah, antimony obviously is one very interesting. I mean, there needs to be a processing solution for that. There's not really anywhere to process it outside of China at the moment. I mean, there's quite a few plans to build smelters and refiners outside, but it's difficult. So that's a challenge, but that's the sort of opportunity. So antimony I like. Tungsten's another one. We had experience of that in the UK, obviously, but that's one which is interesting, and we haven't really seen a massive price response. We've seen a good price response, but not a massive one. And it's been a very challenged industry to develop mature, reliable producers in. So it's a sort of supply, I guess, inconsistency in a rising demand market, particularly for strategically for governments in things like defence. So that's one that appeals to me. I think lithium I'm still quite cautious of. It's a bit like catching a falling knife. Plenty of supply knocking around. You could argue the same for certainly some elements of rare earths. You could argue that too. I quite like the minor PGMs. Those look very interesting. Again, it's sort of hard to get exposure to these sort of things. But there's certainly opportunities. Like I said, you've sort of got to be nimble and try and ride one opportunity to another.
I mean, you say they're hard to get exposure to. Are there any ETFs, for example, that you might know of that could follow any of these metals?
No, one for the future, I think. That's certainly one I'd love to, conceptually we've thought about as one I'd love to explore, within Xcelsior, because, why not? And you wouldn't be able to, there wouldn't be enough exposure to create an ETF within one individual metal, for example. You couldn't have any antimony ETF, but you could have the critical metals and minerals ETF, for example, that explores all these specialty metals, and that would certainly, I think, would be attractive to a lot of investors. But if I put my BlackRock hat on, we could hardly trade the big funds who run lots of money. I could hardly buy these sort of opportunities in public markets because they'd be buried within one mine, within one company, and would be a very small part of the revenue most of the time. Or, like I said, you couldn't get the liquidity to trade in and out of it in size. So it's very challenging, and you always want I always wanted exposure to some of these commodities, but couldn't actually do it.
Yeah, interesting. So you don't think that, for example, tungsten on its own could support an ETF? It would be better wrapped into a larger product.
No, no, it'd be very tough. And then also, why would you? There's not many players in the tungsten market, for example. And also, why would you want to do that? As I said, these are small commodity markets, quite volatile. It might be good for 2, 3, 4 years when there's a sudden shortfall and a gap in supply and demand. And then typically these metals tend to revert to their long-term means. So you'd want to basically be almost like not quite a hedge fund, but you'd want to be, positioning yourself so that you're timing these smaller commodity markets. So one's up, one's down, and hopefully you've got enough of a spread, to hedge your bets.
Yeah, I suppose the only thing that occurs to me there is that, I mean, you mentioned that there is a very large amount of these specialty metals. So, I mean, the prices presumably sort of go in all directions depending on different factors for different metals. So it might be hard to kind of read or sort of read a trend across the whole broad spectrum, or am I wrong?
No, you're absolutely right, and particularly because you just can't you just can't pull up any expert analysis floating around on Google somewhere. They're usually behind the paywall of some consultancy that has usually they have some good expertise and they can do forecasts and they know the market and players, but they're still behind the curve relative to the traders. So it's a very opaque market, a lot of them. So it's hard for your average investor to get clarity and comfort that they're sort of good investments. But that's the kind of thing that Xcelsior and Wogen we're hoping to sort of bring to light and hopefully adds another string to many investors' bows.
So can investors participate in Excelsior then?
Not currently, no, but that could change. We will, as success grows and we build up a track record, we'll certainly look to bring in some discretionary capital.
Okay, so it's going to be a sort of case of watching this space in that regard. And if interested parties do want to watch this space, how should they go about watching?
Well, you can keep a track of our progress and what we're doing, through the website, xcelsiorcapital.com. It's still very early stages for us, but we hope, within the next year or few years, perhaps that will, as we build up more of a track record and have more success, then people will see sort of regular news flow. And certainly, I'm a regular poster on LinkedIn, so I've just created a Xcelsior Capital LinkedIn group, so you can follow us on that and just track the news and wait for our exciting news.
And so I mean, talking about the future there, then how do you see the specialty metals sort of fitting into the broader metals market over the coming couple of years, Cailey, or even further out? I mean, are you sort of in a bullish frame of mind these days in terms of the future? I know the present is a bit chaotic, and a lot of people are sort of finding it hard to read, what's going to happen from one week to the next. But actually, some people are saying, yeah, the present is confusing, but I've got a view on what's going to happen in a year or 3 years' time. Do you sort of think like that?
Yeah, I mean, there's almost three time frames at the moment, right? There's the tweet time frame.
Yeah,
There's the short-term time frame, and then there's the long-term time frame. So
yeah,
the tweet time frame scares the hell out of everybody, and is no use, and it just doesn't help anybody. Our traders, it causes havoc for our traders at Wogen because they're trying to they could have product on ships when suddenly there's a tariff that's put
yeah.
into place. So it's just awful. Short term, to answer your question, I'm very positive because this is only going to exaggerate current trends. People are desperate for some of these metals. It's an education process as much as anything. And the US is only just waking up to the fact that they need all these critical metals and minerals. they don't have a clue how they can get it. That particularly the US has been very slow to permit historically mines, and even if they, which they're trying to now support, the Department of Defense is now trying to support many critical strategic projects, both in the US and indeed somewhere places abroad, to secure that supply, but they still don't have a processing solution. So, I think this is an incredibly interesting time, probably the most interesting time. And the whole rhetoric across the industry, which I suppose answers the third one about the long-term, views on the specialty metal space, is that there's got to be a longer-term solution for these metals. We can't. It's become blatantly apparent, although presidencies terms are typically very short, to make big judgments in markets, but it's just highlighted the fact that we can't have a massive reliance on China, because it's too much of a risk to secure your own resources. So I see this as a trend. These, as I said, these are small markets, so they're always going to be volatile. We're always going to see, prices bouncing along the way. But never have I been so more positive about this sort of area.
I mean, it's interesting. You mentioned China there. China seems to have been successful in, let's say, for shorthand terms, cornering a couple of metals markets. But they are quite small ones, aren't they, really? I mean, the Chinese have not really gone for any of the bigger areas in metals trading. So do you think the Chinese positioning in this regard is more political in a global context? I mean, obviously they're going to make money if they corner the rare earths market, but does anyone really care about rare earths that much? I mean, it's a lot of smoke and sound and fury in the papers, but if the rare earth price goes up, then more mines will be built in the West. So is it really not the case that actually the market will look after this kind of situation, and we're only talking about relatively small scale commodities that China are able to manipulate in this way?
Yeah, I mean, that's a very astute observation, Alistair. And you're absolutely right. Rare earths is a sort of oxymoron, right? They're not really
Yeah,
rare.
yeah,
And the same with lithium. There's plenty of lithium sloshing around. But what China had the foresight to do was to tie up to bring their mines on production, which are very quickly, and dominate supply, which is the West has been very, very slow to do. And then of course completely have almost like close to 100% of the processing capacity. So they've been able to dominate those markets and manipulate it. I think that that will change, but that's the sort of caution, in between. Each one of these metals and minerals have their own idiosyncrasies, and that's where you've sort of got to be cautious. And I mentioned lithium. I think rare earths is very similar. There needs to be a sort of solution. It's a very tricky suite of metals, particularly on the processing side, and most the mining's relatively straightforward compared to the processing. But yes, it's sort of capturing that market, trying to build in some security, reducing risk, and trying to smooth out the sort of price volatility that exists there. And I think if this sort of, I don't think that tariffs will go on forever, but certainly the trade wars could. And in that instance, the world doesn't really want to be heavily reliant on one particular country. It doesn't, nobody, I don't think there's any government in the world that really particularly wants that. So it makes sense to sort of spread the load, so to speak, and have more secure supply chains, have a better security of metal coming into their countries. And that could lead ultimately to different tiering, different price tiering in these metals. And that's what we've seen in antimony. The price of antimony, I think, in China is about half of what it is. It's more like $30,000 a ton. So it's that you get this massive tiering, and that could happen more and more so because customers are willing to pay up to know that they're getting, legitimate metal from a legitimate source, not cobalt from the DRC, which they're not quite sure of how ethical it is.
Yeah, I mean, on that antimony dynamic that you just mentioned there, I mean, is this a type of market where you can do arbitrage, or is it too tight for that?
Yeah, I mean, I leave that to the traders, but I'm sure they're very skilled at being able to do that where they can, right? At the moment it's closed borders, so it's more challenging than it is an opportunity in a lot of instances. But certainly that's how traders are one way traders can make their money.
I mean, you mentioned cobalt just now, Cailey. I mean, cobalt seems to me quite an interesting case because, I mean, I know of at least one cobalt project in the USA. You may know of more, but I know of at least one that's just been knocking around forever, and no one's ever actually developed it. Not because it's no good, but because it's actually just a bit too expensive at the current cobalt price. But everybody knows if cobalt goes, cobalt, I don't know the actual number, but say hypothetically, if cobalt doubled or tripled, then this mine would suddenly, or this project would suddenly become economic. And all of a sudden, the USA would have a homegrown cobalt mine that it could just source cobalt from directly. But at the moment, it doesn't want to do that because actually the cobalt from that mine would be too expensive. And I sort of get the feeling there are quite a lot of examples across the commodities spectrum like that, where there are projects waiting around for higher prices. And it's not really about the lack of potential supply. It's really how are we pricing these commodities?
Yeah, absolutely. And this is where China has got it all sewn up, and the rest of the world has missed a massive trick, which is subsidize your industry. Take a hit on
Yeah.
the government level, but then completely being able to control those kind of markets, and that's what they've done. They built their whole industry on government subsidies, and we're only just trying to do this now. The UK government is obviously trying to look at what kind of resources they can invest in. The US now is going frantically trying to do it, but that's what you have to do. Ideally, if take your US cobalt example, the US Department of Defense or whoever, Yixin, I can never say it, the Export Credit Agency in the US, they're going to have to underwrite these projects in some way, and whether that's putting a floor under the price or whether that's giving them very cheap credit or some kind of support. And that's the way a lot of these mines are going to need to be built, because quite frankly, the tricky markets, as you alluded to, they're usually in a jurisdiction which has high cost. The US is a lot more expensive to run a mine in the US than it is in the middle of Africa somewhere. And also, the quality, the geological quality of some of these assets just isn't there. I went to Tenke Fungurume, the Tenke mine in the DRC. Before it was built, I can't even remember when that would have been, like 2005 or 6 or 7, something around then, when Lundy Mining and Freeport owned it back in the day. And I was told, oh, this mine could produce, as a byproduct, could produce 30 or 40,000 tons of cobalt. That's like half the market from one mine. So
Yeah.
on the one hand, it's great because that could be a brilliant, clear, visible, consistent supply of cobalt to the world. But on the other hand, it's awful because it's coming from a place where people aren't comfortable. So that's the challenge.
I mean, it's amazing how some big projects can just completely drastically alter the market with the initiation of a new supply. I mean, imagine, for example, if a really large niobium mine was suddenly developed, it would put the whole niobium market out of kilter for ages. So it's sort of is possible to distort these smaller markets that you're involved in with big projects if and when they do get developed.
Well, that's right. So the only saving grace is if it's domestics, if it's a domestic mine giving domestic supply, and then that gets tied up, doesn't distort the markets. It just fragments it. We've seen that in antimony. There's two mines being pushed forward there by the US government. I mean, the gold, silver, but they have antimony as a byproduct. But they could produce, in between the two of them, they can supply certainly about half, if not more, of the antimony needs of the US, domestically. That's fantastic. So, yeah, who knows what that will do to the price? I mean, but if it's security of supply, and end customers are willing to pay a premium price for that, then it will almost become like an industrial mineral, right? Like, I don't know, the aggregates market or so forth. You pay what you pay the price on supply and demand in a very small area.
Yeah. So are you guys sort of looking at potential transactions all the time then? And how many do you think you might sort of end up doing in a given year?
Oh, that's a good question. I'd love to have that answer myself. I'd be very happy if we can nail a handful of deals in a year. That's probably a push, but that would be the ideal thing. We are frantic. We're getting lots of inbounds, lots of interest, and we're because we're not necessarily, we've got an ideal sort of business model, as I explained earlier, but it's much wider than that because the opportunity set is so broad. We're up and down the chain. We get everything from mines to just a customer that says, "Oh, I need some concentrate. Can you help?" Or, "I just need some working capital. Like, can you help?" And if there's a sort of metal angle and something we can draw on our expertise, then there's so many fascinating opportunities.
Do you have a typical deal size?
Yeah, I mean, we will syndicate, so we don't have to be the only player in the market. But typically, our deal size, sort of 5 to 20 million US. That's what we would sort of put to work. But like I said, we could syndicate quite happily to be part of a larger deal syndicate.
Yeah, and are there a lot of syndication opportunities in the space that you're in?
Yeah, because I mean we're creating them, right? Because people don't have their exposure. There's only so many copper mines you can finance, but certainly doesn't. There's so many quality ones, and everybody's fighting over the same pool. So everyone's very interested in sort of what we're doing, and hopefully we can, bring these opportunities to bear.
So let me change tack just slightly here. With these specialty minerals, one phrase that we haven't used in this conversation yet is critical minerals, which seems to be the sort of market buzzword, which at least I don't know if it covers the exact same ground you're in, or certainly some of it. But I mean, there's a lot of hype in when people talk about critical minerals, about green energy and the global energy transition and so on and so forth. And we haven't mentioned that in this conversation. It could have come up, but it hasn't. Now, is that because you don't regard that as a key factor, or is it simply because I haven't got around to asking you that question yet?
It's like slightly the latter, but I mean that's what these specialty metals is a bit broader, but most of them are critical. I mean, you could argue everything's critical when you haven't got enough of it, right?
Yeah.
So you could almost put gold in that bucket in some regards if everybody wants gold. But no, I've been facetious. In answer to your question, I think the word critical minerals and metals and minerals has been around for a good few years now. I think that what's slightly different is the narrative within that has shifted. Lots of governments, including the UK, have a critical minerals policy. At the moment they're coming out with a new one, and they define what. Usually it's a sort of two-part piece of like the critical minerals and metals that they want exposure to. So there'll be a list of whatever it is, 20 or 40 or something like that. And then the ones that they are willing to support domestically to get there. So that's trying to secure the supply angle as well. It could be domestically. Sometimes it could be internationally as well. But what's interesting to my point is that the narrative previously was very much about green and energy transition and so forth, and that still hasn't gone away. It's somewhat, I would say, walked backwards slightly, because I think, firstly, because people have realised perhaps projections and demand estimates were too ambitious, and perhaps because just some of the hopes and plans were just unrealistic, for what was needed, and it's going to take a lot longer to do those. So I think that trend is still very much moving forwards and still is critical. But what the bigger narrative now has all come down to security, and particularly defence security and governance, and obviously that's been blown out of proportion hugely by Trump's interventions globally. So it's been a shift of narratives. I think the critical is still there, but the narrative from sort of green energy transition has shifted to more security.
I mean, you and I have been around for a few years. I won't say how many, but we've both seen various different types of marketing strategy from the junior miners that come in and say, well, it's all going to be rosy because of this narrative, super cycle, China, green energy transition, national security interests. So, I mean, it seems to me sometimes that actually the US political vibe is often, a way to predict how the next mining marketing trend is going to go, really. I mean, the Biden era was all about the green energy transition, and now we're a bit more about national economic security under Trump. I guess all these factors sort of relevant all the time, really. It's just which one comes to the fore.
Yeah, yeah. No, I mean it's fascinating, isn't it? Right? Like without again, when I had here, we often talked. It was a cyclical industry. Mining. I don't even like the word mining industry much. I much prefer metals and minerals industry. I think it's got a bit of a bad brand, but let's call it that for now. So the mining industry was a cyclical industry, and typically it'd be 7 to 10 year cycle. Prices would go up, mines would get built, then demand would wobble, something would happen. We had China come along with a huge super cycle. Everybody thought we were off to the races. China was racing along at a 7% GDP rate, growing on top of a few billion people. And then the GFC happened and crushed all that to bits. And then the market tried to bounce. So the cycles went on and on and on. I think what's massively different this time, which I find not just interesting but exciting, is the industry's moved from being cyclical to sort of structurally thematic, and the themes that like you've eloquently said are changing and shifting, and obviously all the junior world and the promoters are trying to capitalize on that, which is understandable because everybody does. But undeniably, what is going on is all of it at once moving upwards. So we've, instead of this reverting back to norms we've seen in a cyclical industry, we've just seen a shift slowly moving up and up and up for various reasons. And I just think that's going to continue. It's such an exciting time in the industry where actually people are looking at our industry from all sorts of lenses, but are interested in it. Whereas before it was that dirty, horrible, extractive industry. Whereas now it's people are waking up to the fact that it is critical in many different ways.
Yeah, well, I suppose that's a very optimistic take, really. If you were a junior explorer trying to raise money, you might have a less of an optimistic outlook on the sector. I mean, let's sort of just think about the AIM market, for example, like the local market to where we are, has been shrinking for some years now. I mean, it underwent a huge expansion about 20 odd years ago, or even a bit longer. and it's sort of gradually been sort of contracting since then as far as the what did you say? The metals and I'm not going to say. I'm trying not to say mining now, Cailey, but I can't avoid it.
Metals and minerals.
Metals and minerals. Yeah, as far as the metals and minerals sector is concerned, it's been contracting for, the better part of a decade in terms of the number of listings, to the point where at one point it was a major market for junior miners, and I still think it's just about justifying that status, but it won't be long before it really isn't that significant when set against the Canadians and the Australians if these current trends continue. And obviously the trends are not isolated. It's about the changing way that finance and metals and minerals projects meet each other. And you're obviously working on your own solutions there inside of Xcelsior, but I wonder if the old model for financing exploration is just a bit moribund now.
Definitely partially broken. And to your point, if we just take a small step back, so what we've discussed really up to now is the industry opportunity, and I think that's very compelling. But you're right, in terms of the investment side of the community of the piece, that is very challenging in certain jurisdictions, and there's many reasons for that. When I worked at BlackRock, my generalist colleagues would typically sort of tap me on the shoulder every 6 months when a commodity popped, and they said, they would say like, Rio Tinto, should I look at Rio Tinto? And then I'd say yes or no, and then they'd go away again, and I'll hear from them another 6 months later. And that's pretty typical, and that's because most of the money and institutional money, investment money in this country looks across the piece, that we don't have our own mining sector. It's very different in Australia, where that's such a huge part of their market, such a huge part of their culture. So they've got a frantic retail community there. It's very buoyant. They're very easy to raise money when markets are hot. Canada used to be like that, but the retail community moved on. They went from being exploration stocks onto cannabis and Bitcoin, and then now AI. They haven't really gone back to exploration. So the Canadian market's shaky. We had as you and I both cut our teeth in the sort of early in the city in the sort of early 2000s when the AIM market was booming. I can just remember 7 IPOs in 1 week. I mean, that is insane. There was 26 diamond companies on AIM at one point.
Right. Wow.
It was nuts. But for worse, like in hindsight, for worse, because there was a lot of rubbish companies that came to market, sadly, and that's tarnished the reputation of the industry. I think that if you're through those cycles, you get a new generation of investors that come through. They get burnt and then they go away, and you never see them again. And that's what's happened in London. So it's been a rebuilding credibility exercise. So I do feel like the investor appetite has sort of slowly been clawing its way back, but it's just not going to go back to those heady heights. We don't really have a massive retail community. That's the first point in London, sadly. I'd love that to change, but that would need lots more tax breaks or a local industry that we feel like we could support, which some of the companies here, by the way, are doing, right? They're doing crowdfunding now. So if you want to invest in some Cornish, exploration company, there's probably a crowdfunding you can do for it. So there's sort of these niche angles that are coming up. So the first point, not much of a retail community. And a domestic industry. Second point is institutional money in London has become more and more challenged to invest, in mining generally, and active equities. Coming from my previous role, active equities is a shrinking pool of capital, and so there's less funds that can finance these sort of projects. More broadly speaking, money's moved from traditional actively managed funds to passive funds, ETFs and so forth, or just chucking it into like a broad-based, pension fund. So there's a lot less money, a lot less institutions that have money to work. And then the third point, I think, is it's just become jolly hard to sort of find opportunities that are so compelling that can draw the generalist in to our sector, because they're comparing it across a very broad range of industries. And mining, it's a rounding error. Like we've all heard it. Nvidia, whatever it is today, $3-4 billion trillion market cap, that can buy the mining sector and probably the energy sector as well. So it's very small for a lot of institutional money.
Yeah, so a friend of mine, Cailey, who you know as well, Lawrence Reed, always used to say that comparing a mining company to a pizza restaurant, you could raise £1 million, open a pizza restaurant, and it would be cash flow positive within 9 months. Whereas with the mining company, you could raise £1 million and you probably have to wait 10 years and have raised a lot more money in the meantime. So, the comparative ways of looking at mining compared to other sectors, it's really is a place for the specialists.
It is, it's high risk money, but it's the risk reward thing, isn't it? And but you're absolutely right. If you invest in that pizza company, maybe you get a 7% return. If you put your money into an exploration company, it's either going to be zero or you're going to get like a 7-bagger.
Yeah.
So that's the opportunity. So if I was putting my PA hat on at the moment, well, you want a bit of both, don't you? You want a few blue chip stocks, you want a few different sectors, and you want a little bit of fun in there to give you a potential retirement pot.
Yeah, I mean that reminds me of Hendo, the legendary Ian Henderson, who used to just have massive positions in, I don't know what he had, sort of BHP and Barrick, and then he used to just put sort of 50 grand into tin pot junior miners just so that he could have, someone to go for a drink with at the end of the day and a nice time and a good site visit. I mean, there are different ways of investing in this industry and enjoying yourself. I'll say that. But I mean, what occurs to me, Cailey, is that, I mean, on that, a lot of us sort of raised our eyebrows at this really high gold price that we've had over the last many months, whilst the junior gold exploration sector was just as moribund as it has been over the course of many years. And I mean, that's a connection that seems to have broken, that might not have been expected to break, in the sense that in previous cycles, I mean, you're talking about cycles no longer really being the case anymore, but in previous cycles, if the gold price has gone up, gold explorers used to follow the price, and now they don't really seem to do that. And I think that's causing a lot of sort of junior gold CEOs to scratch their heads and wonder what their next move is.
Yeah, and I've got a lot of sympathy with that. I get asked all the time when I do, keynote speeches at conferences and panels and so forth about that. So, and just sit with companies generally, and usually, at the end of I've asked a lot of sort of stupid questions, and at the end they sort of say, "Can I ask you some questions?" And I'm like, "Yeah, sure." And they say, "Well, why is our share so cheap if you like it so much?" Okay, good question. And the reality is, going to put my old fund manager hat on here, is there's just not the liquidity anymore that there used to be in a lot of this junior sector. And with the exception of the ASX in Australia, they do have that because they got that retail following. They do have liquidity, so they can trade. But there's previously, what would happen was, institutional money would, particularly generalist institutional money, would go to the big caps first, buy Newmont and Barrick, and that would get their gold exposure because they would be underweight, and more scared than willing to get some kind of return out of it. So just FOMO. And then as things started to heat up and get exciting, they're like, well, okay, what can we do with the mid caps here? Maybe they can make some money. There's some interesting opportunities. These guys actually have growth, so they get used to stock picking. And then eventually they would filter down and build up a tier of junior ones. But we number one, we haven't had that, and that's meant less and less liquidity in the market. And as I mentioned earlier, with less and less institutional money more broadly to put to work, whether it's small funds or big funds, that's just meant lower and lower liquidity. And the liquidity constraints on running a fund now are, along with all the other regulations, are more and more onerous. You used to get, when in my old shop, there's risk committees and so forth. And, even there was any bump in your liquidity threshold, they'd be down on you, crack down on you, like, within hours. So that's the reason why. It's just not enough buyers. And that's why junior share prices have been, have not been as exciting as one would hope. I think the exception to that, apart from Australia, as I mentioned, the exception to that is success, and also particularly world-class success. So not just finding a discovery, but finding a discovery which is of a world-class nature. So your average gold company, junior, is 1 million ounces, a gram or a couple of grams, 100,000 ounces a year type operation, maybe in West Africa or something like that. It's just not that appealing to most, to most people these days. So, it needs to be staggering. New frontier, new opportunities, different jurisdiction, amazing grade, you name it. Those are the ones, the junior companies that really getting the attention of institutions and the broader investment community.
I mean, I was going to say, do you think there's any chance that the gold majors might themselves bail out the junior gold explorers, given that the majors themselves are so awash with cash that they don't really know what to do with it? But it sounds like you're saying not really, because actually a lot of the projects inside the juniors are just a bit too small for these guys.
Yeah. I mean, there's a few points there. I mean, the first is we have seen increased M&A activity
Yeah.
in the gold sector, and I think that will continue. But part of that's been a fight to scale, right? If you asked me 10, 15 years ago, being big for the sake of being big, I would, cried. But it's true. You do need to be of a certain scale, so companies are merging together to become more relevant to the investment community. They haven't really picked the juniors, like you said, and that's been partly a function. Well, I would say 2 points. One is the institutional money has gone away, and retail sector, depending where you are in the world, the retail sector's kind of there or not. So yes, the junior company has had to look to different funding sources, and they have gone to companies, private equity groups, and so forth. So these companies, have become the sort of funders of choice in some regards. They're inundated. They're getting, probably more projects come through their door than an institutional investor would. So they can be fussier. To your comment, yes, absolutely, they need quality, they need size to make them investing. But also, I went through this exercise. I do some advisory work for Japan Gold, and I went through this exercise with them. If you go around all the juniors and mid tiers in the gold sector and ask them what their greenfields exploration budget, it will make you cry. It's tiny. So they just don't have much money. Although you're right, they're making a lot of money, but that's going to, shareholder demands. It's going back into projects. It's going to fix various issues, and there's just very little going and extend mine life, obviously, and just very little going into greenfields opportunities.
I mean, one company that has been a standout performer over the last several years in the UK is Greatland Gold, which I suppose ticks a fair number of the boxes that you were mentioning earlier. I mean, it's got good grade, it's a big resource. I hesitate to say it's in a new jurisdiction, but it's big enough and bad enough or big enough and good enough, really, I suppose I should say, to sort of make sense in a way that most other projects just don't.
Yeah, that's a great example, that's there. And I've got a lot of I don't know. I've always had a sort of warm feeling about it. When I was in my old shop, we couldn't really. It was always a bit pricey. The shares run very quick. So we had a problem a lot with, particularly with Australian companies, because the retail community there is so frenetic. You'd hear about a discovery in the one hole, and the market cap of the company would be like $200 or $300 million. Well, I've missed it. So, and Greatland Gold, which was rare for AIM. I don't have to tell you that it's very rare for AIM for a company to get recognition. So it was an expensive. I mean, I can't remember what it went up to, but $1 billion or something like that. I think at one stage. So it sort of almost had to backfill that valuation. And then when Sean's come in, he's done a fantastic job, and he's done the Telfer deal, and they kind of backfilled a lot of that valuation. But now I agree, incredible company, great story. I get so much satisfaction seeing good people and good projects, and when things aren't quite working and there's synergies which are being misplaced between assets or companies. It's so nice to see things being put together and a better outcome for the industry and the investment community as a whole.
Yeah, I mean, the trouble is from an investor's point of view, I mean, as you and I know, back in the days when Greatland didn't really have anything, there were hundreds of companies that looked like Greatland, and being able to pick out in advance the fact that Greatland was the company that was going to make it when set against all these other opportunities that were knocking around in its peer group, it's an almost impossible task, really.
Yeah, and that's having sort of some kind of specialist or sector nous, and you and I have been to plenty of conferences and seen all the private punters milling around trying to find the next opportunity without much knowledge. And it's tough. It's tough. Usually you go on hearsay and momentum, right? What's a good example? Sirius, which the potash project up in Yorkshire, now owned by Anglo.
Is it really potash though? Are you counting that as potash?
Polyhalite.
Yeah.
Again, I've been to that project. I've been to Woodsmith, and it's almost a thematic company, right? Because it's a sort of new product. It's a sort of price discovery, market discovery. It's not really a traditional mining project at all. It's very expensive to build, unfortunately, and high risk. But it would have been a classic case of you'd have jumped into a taxi and your cabbie would have said, "Oh, mate, what do you do for a living then?" And you say, "Well, I look at sort of mining companies." "Oh, you're serious?" I've got my mum's just bought some of that. Do you know what it does? No idea. So yeah, it'd be plenty of those sort of stories knocking around. But I like it. Coming from a community where we don't have an industry, I kind of like that. I'd like to see that. I mean, that would happen every day, every hour of the day in Australia.
Yeah, I mean, you mentioned the UK sort of the UK actual mining scene earlier on in our conversation. I mean, do you have any view on that? I was asking John Mayer about this not so long ago, and he didn't want to comment um, for reasons which I can't recall. But in the context of crowdfunding, which you also mentioned, I mean, we've got I think it's Cornish Tin crowdfunding at the moment over in the West Country. There's Cornish Lithium, there's Cornish Metals, there's Strategic Minerals. I'm sure I'm missing one out. There's this sort of little cluster of local junior companies. I mean, Tungsten West as well, slightly more, slightly off to one side there. Do you sort of have any particular view about the UK's homegrown mining industry as it stands at the moment? Is it going to amount to anything, or is it just a sort of a small bit of local fun for people to enjoy whilst the real action takes place elsewhere?
Well, yeah, I mean, I would sort of sum it up as warm but challenging.
Yeah,
I mean, I would like nothing more than us to have, the Coolmore to have a rebirth in its industry and fund local jobs and infrastructure, all of that, and yeah, and you can visit there, and you can go down and visit there on a 3-hour train ride rather than jumping on a plane to the middle of a rainforest somewhere. It's fabulous, and obviously it's got to be done well and right, and there's more regulations and environmental constraints and so forth. So I would love, and same up in Scotland, the actual case of it is we've had very few success stories. There's been, and that's partly sort of threefold thing of funding constraints, questionable management, but that, to answer your question probably more directly, is not exactly top tier quality geological assets, and that's probably the biggest challenge over and above everything. This is very, that's what in the world stage these UK assets probably need funding support, government support to really work.
Right.
They just don't have the quality. They're not. If you're producing, trying to make a project in any kind of jurisdiction, but particularly a well-established jurisdiction with a high cost base and high regulations, you need to be down the bottom of the cost curve to make it work, to go through, to make money through the cycle, really. And most assets just haven't had that, and that's the biggest challenge. So how do you cope with that? Well, you either need, to my earlier comments about what the US is trying to do, you either need government subsidy to get those mines up and running, because once they're up and running, capex is spent, the NPV and IRR look forward actually work. Once the capex is sunk. Which is sort of what's been going on in Woodsmith. Every year they recut. It's on hold at the moment, but they did recut it every year after they'd sunk another $1 billion into the capex. Eye-watering amounts.
Yeah.
So you either need government support on the funding side, or you need price support. Okay, put a floor under the price, and then these mines all work. But without it, they're going to struggle.
Well, I guess we'll see how we go. And we're coming to the end now, Cailey, but you mentioned Japan Gold a few minutes ago, which I believe you're involved with. Why don't we close out by a quick discussion of Japan Gold? First of all, perhaps just tell us how exactly you're tied in with them, and then we can move on to what they do.
Yeah, well, I'm an advisor to them. I invested in it when I was at BlackRock. I was running managing a couple of Japanese gold funds. It was smaller, so we had capacity to invest in smaller companies because it is a junior end. And I've got very close personal links to Japan. I've been going there for 30 years. So for me, it was a sort of warm relationship. And then once I left BlackRock, I was asked to be involved with the company. So I came on in an advisory capacity to just try and help them with their strategy. And it's an incredibly interesting story. I mean, obviously it's a smaller end of the market. It's only a $30 million Canadian market cap. So it's tiny, and they've been surviving on small amounts of money. But the elevator pitch is quite simply a new frontier. And bizarrely, a new frontier. Japan had a gold mining industry, closed it down in the Second World War. Been a moratorium to reopened about 13 years ago, and there's only one operating mine there called Hishikari, owned by Sumitomo. It's the highest grade gold mine in the world. It's like 30 grams a ton, so 30 times the average gold grade of a normal operation. And it doesn't really have a processing plant because it just direct ships the ore. It's used as a silica flux for the smelters, for copper smelters. So they just want the quartz, basically, the silica. They're not really interested in the gold. And what Japan Gold trying to do, they've got all the ground around it, plus a load of licenses all around the world, all around the country, first mover advantage. And they're just trying to find another Hishikari. And when, if I put my analyst hat on, when you're trying to find a mine which is, 100, 200,000 ounces a year or something like that, that you take away, you double, triple, quadruple the grade and take away most of the processing plant, your NPV just blows out two, 3-fold. So the potential returns on discovery are incredible, but it's going to come down to the drill bit and discover it at the end of the day. They've got Barrick in there for some of their licenses. Newmont are involved. They've got big players, lots of people interested. So we're hopeful. They're drilling this year. Hope for a discovery.
So Canadian listed, is it?
Canadian listed, that's right.
Well, we wish you well with that. Cailey, it's been really great to talk to you. Thanks so much for making the time, and good luck with all your endeavours.
Well, thanks very much for having me on, Alistair. It's been an absolute pleasure to catch up with you. And yes, I look forward to an exciting time in the industry.
Let's hope so. Cheers.